We still think Europe is attractive. I mean, definitely based on valuations, it's hard to see anything attractive about the US market, even with the positive developments on the debt ceiling. So for us, Europe still scores on valuations as an equity market. We still think the economic prospects are pretty strong. You just talked about the German inflation numbers coming down, and disinflation seems to be happening in Europe outside the UK. So there's a lot of reasons we still think to be positive on Europe.
How tactical do you have to be around the European markets, though? You know, are there certain countries that you prefer over others and sectors as well?
On the sector side, I think we still favour Europe in terms of value and cyclicals. The value rally seems to be kind of losing a bit of steam, but with the rate rises that are still, we think, going to come from the ECB, we think at least a couple more in this cycle, we still think that, you know, the value and the cyclical sectors, which aren't really firing elsewhere, are where you need to be looking in Europe, so industrials, for example.
Why isn't this market going down? You know, everybody, every economist you talk to at the moment is complaining about liquidity being sucked out. They're worried that interest rate rises are still to come rather than being totally history at this stage. And they look at some of the data around consumer activity and they worry. And yet, in Europe, we tend to see markets continuing to grind higher. Are you worried that we're going to get a pullback? And if we get a pullback, is it going to be significant?
Yeah, so we definitely think that markets have got ahead of themselves, especially in the US, so less outside the US. So we still see value, as I said, in Europe and emerging markets as well. It feels like now is a good time to be adding to hedges, actually. So with the way volatility's come down, if you look at the VIX, if you look at other measures of volatility across asset classes, we think now is actually a good time to be kind of adding protection and taking advantage of this lull in the markets and preparing for the next drawdown, which we don't think will be huge, but we do think, you know, as you said, this grind higher could lead to more of a grind lower as well.
Altaf, why aren't markets going higher? Because if you look at the data, some of it's very positive. We're closer to the end of the hiking cycle than the beginning, and we're seeing revisions in earnings expectations for companies at this stage. And if you look at Europe and a lot of emerging, on a relative basis, the valuations are so much more attractive than North America. You just see what I did there. Yeah, you can argue both sides. Oh, not that clever, but you can argue both sides of this story with plenty of evidence. And that's really challenging at the moment. So let me ask you that question. Do you think we can have a real melt-up that continues from here on in, based on the fact that everybody seems to be buying the dips?
Yeah, I don't think we can have that melt-up. I think that buy the dip mentality, if it hasn't gone already, should be gone. I don't think central banks have our back anymore. You know, the Fed put, whatever you want to call it, we think has disappeared. We think we're going to see a lot more macroeconomic volatility. There's still a huge amount of geopolitical risk out there. So for us, the risks of a melt-up are much smaller than the risks of a grind down, put it that way.